Gives me great pleasure now to bring on board Mr. Ashok Tyagi of DLF to talk about what needs to be done to revive India from the pandemic crisis. India Revival Mission is a Times network initiative where we are debating, deliberating, discussing, and even more important, ideating what needs to be done by the administration and by various companies to ensure that the growth engine which was off the track comes back on the track. The real estate sector is one sector where surely the pandemic has impacted both demand and the pricing power, and the real estate sector in last couple of years has been in a disarray. And on top of that, if you have a pandemic slowdown, it really could act like a sledgehammer. So first, how bad is the ground reality, and when will there be light at the end of the tunnel? So to discuss all that and much more, I have the perfect guest with me, Mr. Ashok Tyagi. Mr. Tyagi, great to have you on the show. Thank you for being part of India Revival Mission. Hope everything is fine and safe with your loved ones, your family and your employees.
Thanks a lot. Absolutely. Touch wood, everything's fine at the workplace, at home, and in the family. And yes, we are all passing through difficult times, but hopefully, we are closer to the end of this than what we were 2 or 3 months back.
When we spoke to you last, Mr. Tyagi, we were in middle of the lockdown, and lockdown had got partially lifted. Most of the India was under the lockdown. Very few parts of India had opened. Now the reverse is there. Almost entire India has opened and very few parts are under the lockdown. So what has changed in your understanding to demand and the customer behavior? Is the real estate buyer in a shelter now, or the real estate buyer is now back?
Okay, so I wish it could be as binary an answer as you are looking for. Clearly things have looked up and are looking up compared to what they were in that 60 to 75 day period from end March till say mid-June, which is when we spoke last. Clearly that 60-70 day period, frankly, we ourselves as a company also had deferred all the demands to customers as well and everything else. And honestly, neither were any sales happening, nor was too much collections happening. But I'd say that since the Unlock 1.0 onwards, 2 or 3 things have clearly begun to happen. One is that obviously not comparable to the pre-COVID levels, but to some degree, customer interest is coming back. And it's not just coming back in terms of measured in sales value, but also, in terms of the site visits and, inquiries and those sort of things. I think clearly to some degree, the interest of the customer is coming. Obviously, when we are saying interest now, this is the interest for the end customers. Clearly the investors and the middlemen sort of thing, I don't think those are in the play any longer. These are essentially end customers. And if you also saw, while we ourselves did not report necessarily great sales number for Q1, but there are a couple of other players whom you've seen have reported pretty healthy sales numbers even for Q1. Clearly, Q2 should be better than Q1. And I'd say that what we had referred to when we had spoken last in May or wherever, is that I think by Q3, some degree of normalcy should begin returning. The construction workers, most of whom had actually gone back to their hometowns during the lockdown, as you know, I'd say that about 65 to 70% levels of construction activity has resumed at most of our sites now. So it's obviously not what it was in February, but we are broadly at a 65 to 70% levels of where we were then. Office collections have held reasonably strong and resilient throughout. And this is not just true for us. You have seen the numbers reported by the listed REITs and by other players. And the office collections have consistently been in the 95% plus mark. Yes, there have been marginal slowness, and I'm sure there have been incidents across the geographies where individual tenants may have come in for rent renegotiations marginally or for deferring the escalations that were contractually due. And those obviously we are also handling on a case-by-case basis. Our new building, the Cyber Park, which was due to actually go live during the April-May period, got deferred by 3 or 4 months. But most of the tenants have commenced the interiors, and from 1st October, we expect that we should be in the rental mode. The retail mall segment is the one that has been most visibly hit. I mean, 3 months, obviously, they were completely locked down. Then, even though the lockdown was listed, the restrictions continue. I mean, 3 sort of restrictions. One is clearly restrictions on entertainment zones and bars. B is restrictions on operating times. And C is restrictions of social density. And D, obviously, which is the unwritten restriction of people still, feeling fearful of going into public social places. And I think that is we were amongst the first ones to offer rental rebates and all. But I think that is the sector which may take longer to sort of begin to show signs of normalcy, maybe 1 or 2 quarters delayed as compared to the other sectors. That's the broad piece, things looking up, clearly nowhere near what they were in the pre-COVID levels, but hopefully the extreme abyss of darkness in the April-May timeframe, that should be behind us.
Mr. Tyagi, 2019 was a tough year for real estate and for the economy. Now COVID has happened. Now when you say that you will go back to pre-COVID levels, investors would say pre-COVID level is not a great benchmark or a high water mark, because for DLF and the real estate sector to come back, they need to go back to not 2019, 2020 pre-COVID levels, they need to go back to 2018 levels. When do you think you will be able to go back to 2018 and 19, not March to January and February 2020?
Really, we are still about 120 odd days in this pandemic. There are discussions around the vaccine. The fact is that till the vaccine comes, is actually publicly distributed, this animal is not going to get behind us. So I think all of us have to frankly keep our expectations moderate and calibrated in a step-by-step manner to return to normalcy. Things will not come to 2018 or 17, or, your next question could be when would things go back to 2006 or 7 levels? So, I think we have to go stage by stage. Step 1, let's come back to the pre-COVID levels immediately. Then obviously go back to where hopefully the industry was in the 17-18 timeframe before actually going in further. I mean, if you looked at our analyst presentation last time, which was released a couple of weeks back, we ourselves have sort of used this 3 or 4 month period to focus on 2 things. One is clearly do a reasonably aggressive move on costs. So our fixed costs fell off about 35-40% of what they were on a regular basis. And more importantly, we also went back to the drawing board to see that given the reality of the new world where super luxury will only move in at its own pace, unfortunately, what other products can people like us bring to the table which can hopefully A, have a higher offtake, B, mesh in with what the customers expect or the customers are looking for, either from a work from home level or moving into their own homes level. So, a year back, as you know, we were not at all active in even designing products for the mid segment. And now, we are actually aggressively working on mid segments, low-rise commercials, plotted colonies, mid-segment residentials in the sub 75 odd lakh brackets. So all of those things are a lot of planning activities going on, and hopefully, if there are no further setbacks on the COVID front, I think by the time we hit Q4 of this year, you would see not only from us but from the other established players also a certain degree of optimism in terms of new launches and new products to the market.
But do you think the stress in the luxury housing market or the luxury mall business is going to be more like a long-term structural change which is going to happen? Lot of behavior patterns and our day-to-day activity have shifted from offline to online. Are you of the view that the luxury, both mall and the housing market, is in for a long winter?
So, I think it's not just the luxury mall market. I think the mall market across the board is clearly something which is in for some degree of stress. I think that's a fair assessment. Actually, ironically, in our own portfolio, the sales bounce back in terms of the luxury segment, the Emporio Mall, as an example, has actually been better than the than the other malls, because I think, for that segment of population, if they wanted to buy something which they had been unable to buy in the last 4 or 5 months, clearly I think now is the time when some of that bottled up demand is gradually beginning to unravel. Obviously a lot of things which drive the luxury market, like big ticket marriages and all, are still, some time away. So I think there will be some distance before it bounces back. But the mall segment is not on a zero as it was up to June, frankly. While I've seen some more encouraging numbers from some players as well, we ourselves are in the 30 to 40% bounce back range clearly. We're slightly ahead on the luxury segment. But it will be a while before people feel comfortable in going back to malls in the same numbers and for the entertainment zones to start revving up and all of those things. So yes, there is some degree of at least autumn, if not winter, which will continue to plague the mall segment for some time.
Mr. Tyagi, every company I've spoken to, they are telling me the following, that look, we've relooked at our cost structure, and guess what, when we relooked at our cost structure, we figured out there is 10 to 25% of the cost saving which could be permanent in nature now. At DLF now, because of the pandemic crisis, I'm sure you must have followed the same process. You must have looked at all the line items, all the income statements, all the expenses, and you must have come to a conclusion where some cost savings are permanent in nature. What are your thoughts on that, and how much of this permanent cost saving will add to your EBITDA and margins?
So cost savings are in two components. One is the cost savings in terms of our variable costs, which is construction costs and maintenance costs and all. And there, frankly, we have in the last 5 or 6 months, we have also sort of, hired a new set of leadership, and clearly are working extremely aggressively on that. And frankly, the construction costs that we are coming up today are, you are right, in the range of 15 to 20%, if not more, lower than what we were talking about a year back. On the fixed cost side, our fixed overhead base for, say, fiscal ended 19 was in the range of 600 to 650 crores. And I think we have already taken steps to basically have that number come down ideally below a 400 number, which is at least a 35% reduction. Our Q1 numbers bear testimony to it, but obviously Q1 was an extraordinary quarter. So I think we need to deliver the same cost numbers in the next couple of quarters. But we believe that we should be chasing a 15 to 20% reduction on the variable cost and a 30-35% reduction on the fixed costs. And I think both of those are eminently achievable targets. The consistent 3 months work from home has led to a lot of new ideas which frankly, have sort of helped. So really variable cost, fixed costs and interest costs, I think we are seeing southward trends in all the three of them.
If I look at the glide path of your debt reduction, I'm using the last quarter as an exception because I'm sure cash flows would have not gone well, and there also the debt has not gone higher, it's marginally down. What would be a glide path for debt reduction? Pre-COVID, you'd given us a glide path. Post-COVID, how will that change?
So I think, it will not change. But yes, there would be a deferment of 2 or 3 quarters, which will, unfortunately happen in that. So I think we still believe that we should be down to a debt which is near zero. In my assessment, a number less than 2,000 is almost near zero. And I think we would ideally have tried to achieve it by March. Now maybe, we are talking of maybe 2 quarters to 3 quarters hence. Okay.
Mr. Tyagi, DLF is one company which will be able to perhaps, which needs to address 2 things. One, for a real estate buyer, what are the trends they should expect in 3 years? And for your shareholders and investors, what should they expect in next 3 years? So let's address the first bit. For somebody who's planning to buy a house, what is your understanding of where real estate prices and housing trends are? And second, for those who are looking at investing in your stock or already invested in your stock, what should they expect in next 3 years?
So I'll answer the first one, which is that what should the customer be looking for today? Frankly, clearly the customer is also at least in one sense, in a very sweet spot because the mortgage rates are now almost at a historical low. So actually, if somebody needs to take a mortgage loan, and especially if you are in the younger profile, then I think this is about the best time in a generation for taking housing loans, really. B, the product, obviously everybody has their own sort of, degree of affordability. So for somebody, a 50 lakh house is affordable. For somebody, a 4 crore house is also affordable. And I think clearly people should focus on what they can comfortably service. I mean, almost everybody out there is offering extremely user-friendly payment plans now. There are extremely aggressive early payment rebates that are there. So I think, but there are two things that a buyer should not compromise on. One is the credibility of the developer that he or she is buying the product from. Look at their past track record, etc. And B, I think clearly is the location. While I understand that the quest for a lower price product may at times drive you further away, which is fair, but at least go into locations, even if they are further away, which have connectivity which is existing or connectivity which is on the anvil, versus actually, driving 60 kilometers and actually not having a comfortable commute either way, frankly. So I think location, credibility, and obviously the total track record of delivery of products, the specific product itself, all of those things, are important. I think RERA has done a great job in terms of providing a degree of reassurance to the customers. And I'll be very frank, at some stage when RERA was introduced, I personally was a slight skeptic, but I think now I have become a convert. RERA, honestly, some clauses apart, I think is a great sense of assurance to the customer. And so I think that's what the customer should be looking for. Don't look for dream offerings. They won't happen. And if they are, there will be something hidden there which will hit you at some stage. So if a product in a particular location should cost 50 lakhs, and if somebody is offering you at 35 lakhs, I'd still say that be very careful.
Okay, let's now talk about the rental income, Mr. Tyagi. The company has taken a very judicious and a very empathic call, and perhaps have looked at addressing the concerns for your tenants. You've taken an option of giving one-time rental and reducing rents down. But ultimately, shareholders would say that, look, this is a cash flow which was a strong proposition for DLF. So what will happen to rental income in next 2 quarters, and the cash flows which have dipped largely because of the waivers you've done, when will they recover?
So the offices rentals have sustained, they have been extremely resilient, and our office rentals continue to be in the 95% plus collection range, 95-96% collection range. So actually, contrary to what one reads in the pink newspapers, the office rentals haven't so far dipped. Yes, there have been isolated discussions, which are understandable given the way the times are. We ourselves sort of debated internally for about 3 or 4 months, and then decided to continue with our 2 existing new capital assets creation, one in Gurgaon and one in Chennai, with both of whom should be on stream maybe in about 24 months from now. So the office collections is good. The retail collections is where the pain has been, and where we have given all these waivers that you mentioned about. Retail collections for us is about 1/6 of our total collections. And we do believe that this particular year, we should clearly have we would have a net deficit on the retail piece. But again, if what early trends, what one is looking at, what one is looking at in terms of retail bounce backs in other geographies of the world where COVID which were at an early cycle of COVID, including China, maybe even for retail, it's a question of 2 or 3 quarters, where when things are uncertain, and eventually it should begin bouncing back. Obviously, the retailers will have to, I guess to some degree, weave in the online experience into their sales strategy, and that's something that obviously the retailers, the mall operators, and everybody will have to sort of work on with the technology backbone. So every time you want a new bag or a new dress, you don't necessarily need to go physically to that shop. You could maybe order online from that shop. And those sort of, I think, I'm sure innovations will happen. So retail is the one which would have a slightly longer interim pause period. But again, fundamentally, from a shorter standpoint, as you mentioned, that what they should look at is hopefully a 2 or max 3 quarters interim, a pause on the growth trajectory of the rent. But we believe that the rental trajectory that we had earlier guided the market to, that by March 22, we should be on an exit run rate in excess of 4,500 crores per year. We still believe that that could get delayed by, say, 3 quarters, but the basic trajectory should not really get fundamentally compromised. That is the set of assumptions and the sort of the house view as of today. Obviously, the only big unknown in this is how does the COVID play out 6-9 months from today, and that's something that obviously we have to just wait and watch. But given where we are today, I think we do expect that the trajectory has been sort of slowed down by 2 or 3 quarters, but fundamentally the trajectory isn't going anywhere.
Of course, investing is all about risk and assumption. That's your view, and they need to do their own homeworks. But thank you for at least giving us the very black and white picture. They'll have to fill in their colors.
Sure.
Mr. Tyagi, another question which keeps on coming, and that's for DLF and perhaps for all the real estate sector, is that you walk on the roads of Mumbai, you go to Gurgaon, you go to any major city, you can see unsold inventory, half-bay construction towers, half-bay construction houses. What will happen now to so much of unsold inventory for DLF and for the real estate sector? I mean, if there is more supply and less demand, are we looking at distressed sales?
So, honestly, we are looking at distressed sale in some of these segments for sure. But I think the more sort of ugly outcome is that in a significant number of those projects, those projects may never see the light of the day. And that's, I think, the shock that will happen at some time, because some of those projects will get rescued by the finance ministers, that 25,000 crore fund, by some other mechanisms, by some asset sale. But there will be some developers, who unfortunately may just not have the wherewithal, and those projects may be so significantly net worth negative that it will be very difficult for them to see the light of the day. And I think hence when we talk of inventory, and the inventory overhang, at least in NCR, we do believe that to some degree it is slightly overstated, because at least some part of that inventory, unfortunately, may not see the light of the day in the foreseeable future. I mean, you've seen the last couple of years how some of the developers, and I mean, not only some of the sort of extremely poor small developers, some of the relatively better developers, at least in the unlisted space, and how even those have begun sort of coming under extreme degree of stress, NPAs, and everything else. And the HFC NBFC crisis obviously just sort of was the final sort of push for many of them. So I think it will be some of that inventory will find it very difficult to bounce back anytime.
Fair point. Thank you very much. So I'm going to ask a very broad question, my final question, Mr. Tyagi, just for the benefit of our viewers. Mr. Tyagi, in India, Indians buy real estate or a house, first to live in and then for investment. Now, for those who need a house to live in, I guess it's a good time, any day is a good day to invest or buy a house. But for those who are looking at investing in real estate or the housing sector, when do you think the tide would turn?
Look, honestly, I don't know how to frankly answer that question. Clearly, for end users, you are absolutely correct. This is a great time to invest. I think if you look at only the investor demand, I think the investors will obviously need to crossweigh an investment in their second or third real estate or commercial property with whatever returns they are making on the other aspects of the economy, frankly. I mean, the debt markets aren't doing great. I mean, opinion is out on whether the equity markets are already overheated or not. So I think clearly, I mean, it's not for us to advise people how they should invest. But I think in many of these products, I think the entry point for a real estate investment is there now. What returns people make obviously is open to speculation, and I wouldn't want to join that speculation. But I think at an entry-level price point standpoint, I think this is a pretty good time for people who have been sort of sitting on the fence to enter real estate. There's a lot of ready inventory out there. There's a lot of fast construction inventory out there, and people are looking at their first house or their second house or the investment thing. I think it's a good time. But how those markets and those price points behave in the future is honestly today, I think we are still in the, in a zone of uncertainty. And I think honestly, it will be unfair of me to advise on how those speculations may eventually pan out.
But thank you very much, Mr. Tyagi. You've been very vocal, very candid. We've covered a range of topics of what government needs to do, where the sector is headed, how DLF is taking a turn, and what are the new permanent shifts which will happen in the real estate sector because of the COVID crisis. Stay safe, sir. Thank you very much, and hope to see much more of you going forward.
Thanks a lot, Nikunj. Thank you.